First, a look at the U.S. economy. Inflation dropped for the second straight month in May, easing fears over new price increases. But that was not enough for the Federal Reserve. The central bank left its benchmark interest rate unchanged in hopes of snuffing out sticky inflation in parts of the economy. For more on the Fed's decision, I'm joined by Daniil Manaenkov. He's the head of U.S. forecasting at the Research Seminar in Quantitative Economics at the University of Michigan. Thank you so much for joining us.
Thanks for having me.
I want to get your take first on this latest Fed decision. Were there any real surprises here?
I mean, whenever data comes out on the day of the decision, it's unlikely that the Fed is going to react differently than the market expected prior to the data coming out. So there's nothing they could have done unless the report would have been, I don't know, catastrophic in either direction. So this is not an unexpected move.
So no cut this time, but are we any closer on any sort of timetable for the next cut? The Fed has signaled there would be just maybe one cut before the end of the year. Do we have any indication of when that might be?
So one cut is the dot plot, which is basically a summary of economic projections by 12 different banks and Fed governors. And most of them would have been completed before the CPI came out this morning. So Chair Powell said that some of the dot plots could have been revised, but reality is the median probably didn't move. So my bet would be that about between 1 and 2 cuts is a safe bet at this point. And the September is probably the last meeting before election. So however many times they say they're not political, they might try to avoid it. So my money is on November and then maybe December.
There are several signs that the U.S. economy is slowing down, and that sounds like a bad thing, but that is actually the point of interest rate hikes. So how are the markets reacting to this? We saw a little bit from John Terrett here, but how do the markets react generally to this type of decision, and how do you see the markets potentially reacting later this month and into the next coming months?
So there are two types of reaction. There is a event type reaction, so right when the data gets released. And that typically goes if markets expect lower rates, I don't know, stock indices pop up. But then markets digest why things are happening. And for example, if we get pretty weak employment report, that would signal economies slowing. So on impact, you might get a pop in the stock market, but then as people digest that actually economy is slowing and that might not be good for profits, the trend for valuation is probably going to be down. This time, it's unclear what this good report in CPI actually means. Is it because we have relaxed supply side conditions because of sizable immigration inflows, or is it the economy is slowing, so demand is weak? So that's going to take time, and basically that's what the Fed keeps telling us. They're extremely data dependent. They're going to try to judge things in real time. So in that sense, what's important is what gets released and how it's interpreted, but things that depend on forecasts, such as dot plots, are probably of secondary importance right now.
You mentioned employment. We had a recent number come out that was 272,000 jobs being added last month. So how is the overall state of unemployment here in the U.S.?
So we have a bunch of conflicting data. So the payroll jobs, the 272 number, in my mind, is maybe a little bit overstating how good the labor market is, because the other major survey, which measures the unemployment rate, has been showing loosening labor market. The unemployment rate ticked up about 50 basis points since July of 2023, coming up from like 3.5% to 4%. So this is what the Fed wants, but if unemployment rate keeps edging up higher, that's probably going to become the primary concern for the Fed and may actually push the probability of more rate hikes later this year. So this is something bears watching. On the balance, I think the truth is somewhere between the household report, which is showing slow pace of jobs, or basically the how many people are employed, and the payroll jobs, which is showing how many jobs there are in the economies. And we're getting headlines that a lot of people are getting part-time jobs, and the bulk of run-up in the payroll jobs over the past couple of years has been part-time employment. And it could be both good or bad. And basically, you cannot look at that like is a single number. So you look at the whole cacophony of all the conflicting signs that we're getting, and I would say the labor market is moving in the direction that the Fed wants, but there are some worrying signs that they may need to pay attention to.
So this continuing battle against this sticky inflation rate, is it going the way the Fed wants, in your opinion?
Inflation is notoriously very volatile. So at the moment, it looks like maybe things are heading the Fed's way, but we thought that way circa December 2023, and then we got a string of pretty bad numbers despite Fed doing all the right things. So it's probably too soon to call for significant progress, and we know that we are currently in a very, very volatile world. Some import price shocks are pretty likely over the next several quarters, and that will probably translate to consumer prices. So there's a lot of uncertainty to basically pat the Fed on the back, so it's, at least at this point. So we'll wait and see.
All right, on that note, Daniil Manaenkov with the University of Michigan, thank you so much for joining us.
Thanks for having me.